investments, that if in a company we have money that we have gotten by selling common stock, which is equity, or preferred shares, right, which is also a type of equity, or let's say if we have gotten some bank loans, which is debt, let's say 10 million worth of common stock, 10 million worth of preferred stock, 10 million worth of debt, and these assets, let's say we have cash of 30 million. Now these assets, the way we invest is what we talked about in your capital investments. And of course, we want to get as high a return on these as possible, which is your IRR. And of course, the NPV should be positive. Now, if you remember, in the previous learning module, we were talking about discounting the future cash flows that we would get from these investments. The future cash flows we were discounting at a certain discount rate, right? We were discounting at a certain discount rate. Now that discount rate is what? It is basically your cost of capital, right? That what do you have to pay to the bank that you've borrowed the money from? What do you have to pay to your shareholders of preferred stock and common stock and preferred stock, right? Or common shareholders and preferred shareholders. And of course, it's going to be a weighted average. So maybe the bank loan will be a little bit less in terms of the cost. The interest might be lower. The preferred shareholders might be expecting something higher, maybe 6%, whereas the bank is expecting 5%. And why do you think the equity holders will want a higher return? Because they're taking a higher risk. If, for example, there is a loss, and instead of increasing, these assets go down, so the bank is going to still want their money back. The people to lose their money will be the common stockholders. They will be the first to lose their money. So higher the risk, higher the return. So what we are basically saying is that the capital investments that you do have a certain return that you're earning, the IRR, and the IRR has to be more than the discount rate that you use, right? And that discount rate is basically your cost of capital. So your IRR has to be greater than your cost of capital. Only then will your NPV be positive, right? Now, how do we calculate the cost of capital? Because as you can see, we have various sources of capital. You can get a bank loan, you can issue common stock, you can issue preferred stock. So we will learn how to calculate the weighted average cost of capital. We will look at the factors affecting capital structure, which means how much of our capital should be debt versus how much should be equity, right? So that is your capital structure. That what percentage of your assets do you want to finance with debt? What percentage of your assets do you want to finance with equity? We'll talk about certain theories related to capital structure. And then finally, we will finish with the optimal capital structure, that what is the optimal debt to equity ratio. So as discussed, we'll be starting off with a calculation of the weighted average cost of capital. Then we will start talking about what are the factors that affect the capital structure, what are the various theories regarding the capital structure, and finally we will talk about the optimal and the target capital structure. Now, what is cost of capital? Cost of capital is what is the rate of return that the suppliers or the providers of capital require as compensation for their contribution. So whatever capital investments you are doing, let's say you're building a steel plant, you need money for it, you need capital for it. Where are you going to get that capital? Well, you can get a bank loan, or you can issue some shares, you can issue some bonds, right? And naturally, you will have to give these investors, these suppliers of capital, a certain return. And that return has to be greater than what they can earn elsewhere in order for you to attract them to your investment, right? So that's where the IRR is important. And of course, if the IRR is going to be greater than your weighted average cost of capital, then your NPV will be positive. And that is what you studied in the previous learning module. So again, coming back to the discussion, let's say assets, liabilities, and equity. And just to keep it simple, let's say you have 50%. So let's say you have 100 million of assets, which you have financed by 50 million liabilities, which is a bank loan, and 50 million common stock, right? Or let's say 25 million common stock, common equity, and 25 million preferred equity. Now, each of these components of capital, so clearly 50% is funded by liability and 50% is funded by equity, which with a further breakup of 25 each. And let's say the bank loan is charging a 5% interest. The preferred equity has a 6% preferred dividend fixed, right? Common equity, of course, there can be no fixed dividend, but whatever is left is the residual ownership of the common equity holders. So they have what's left. Now, each of these components of capital have a cost, right? So 5% is the interest cost of the bank loan. So hence it's the component cost of capital for the bank loan. The 6% is the preferred dividend on the preferred equity. So that is the component cost of that capital. Now, how do you calculate the common equity? If you've already watched the videos for equity section, you would know what is the capital asset pricing model, right? And if you haven't, I'll just briefly tell you what it is. It basically says the return that your common equity holders will want is the risk-free rate, which is the bank rate, plus a certain premium, right? And that premium is actually something which we say beta multiplied by the equity risk premium. And the equity risk premium is what the stock market on an average makes over the bond rate or the risk-free rate. So equity holders basically say, hey, give me at least the more than the bank. How much more than the bank? Well, as much as the stock market makes more than the bank on average, multiplied by something called beta, which is company specific, depending on how risky your business is, right? What are you going to do with these assets? Are you going to go into a risky business, or are you going to go into a relatively safe business? So depending on that, we use the capital asset pricing model to calculate what would be the required return on your common equity. Preferred equity usually has a fixed preferred dividend rate, and the debt has a fixed interest rate that we have to pay. Just one thing I want to emphasize over here is that, and let me make some space for this, is that when you look at the income statement of a company, what happens is that you have your sales, right, minus your cost of goods sold. You get your gross profit, then minus your selling, general, and administrative expenses. You get your earnings before interest and tax. Then you minus your interest. Then you get your profit before tax. And then you profit minus your tax to get your net income. Now, what I want to emphasize on is look at how interest is a tax deductible expense. What does that mean? It means that whatever interest you pay, it reduces your profit before tax. Let's say your earning before tax, let's say your sales is 100, your cost of goods sold is 50. So you're left with 50 gross margin. Let's say your selling general administrative expenses are 30. So you're left with a earning before interest and tax of 20. Now, if I pay an interest of 10, my profit before tax is only 10. And if my tax rate is 30%, so I will pay 3 million in taxes. If I pay a higher interest, my profit before tax will be lower, which means my tax will be lower. So this component of capital, the component cost of capital for your debt, is something which is actually going to help us save some tax. So as you can see, because higher interest means lower profit before tax, which means lower tax. So I further reduce this by multiplying it with something less than 1. And how much less than 1? Well, 1 minus the tax rate. So this is the entire big picture concept over here. And let's get into the details slowly for each of these parts so that it becomes more clearer for you. If you want, you can rewind this video again and watch it again, because we've covered a very large amount of big picture concept over here, which you might need to watch again, and then you can watch it further down from this point, where we're going to start filling in more color in each of those components. Right. So what is the cost of capital? Well, it is the rate of return that investors want for giving you their money, right? Compromising their opportunity costs, not investing it elsewhere, giving it to you. And the higher the risk, the higher the rate of return they will want from you, right? Lower the risk, lower the rate of return they will be expecting. Now, one way of calculating the cost is to determine the weighted average cost of capital, which is also called the marginal cost of capital. Now, what does that mean? See, again, with the assets of 100 million, where are they coming from? Let's say liability 50 million, bank loan, and within equity you have 25 million common equity and 25 million preferred equity. And the bank loan is 5% interest with 30% tax rate. And let's say preferred equity is 6% preferred dividend, and common equity, based on the capital asset pricing model, which I was telling you about in the previous slide, which you will learn more about in equity, is that the return on common equity is risk-free rate plus beta into equity risk premium, which is the return on market over minus the risk-free rate. And let's say that comes to 10%. Just hypothetically speaking, I don't want to get into the calculation of that right now because that is discussed in a different learning module. But let's say that the common stockholders want a return of 10%. Now, let's make some space to calculate the weighted average cost of capital. The weighted average cost of capital, my friends, is going to be the weight of debt. So clearly, if the total assets are 100 million, 50% is coming from debt. So 0.5 is the weight of debt multiplied with the cost of debt, right? The cost of debt, which is 5%. But remember, I told you that interest is a tax deductible expense. So we reduce this by multiplying it with a number less than 1. And how much less than 1? 1 minus the tax rate. So this will be the component of your debt. Then we will add to this the weight of equity, common equity, right? So weight of common equity into the cost of common equity, and that is going to be 0.25 is the weight of common equity, because that's 25 million out of the total 100 million assets, multiplied by the cost of common equity, which is 10%. And we will add to this the weight of preferred equity multiplied with the cost of preferred equity, and the weight is also 25% and the cost is 6%. And when you add it all up, you will get the weighted average cost of capital. Now that is how you calculate the WACC, why have we also called it the marginal cost of capital? So let's say currently you have assets worth 100, right? And where have you gotten this 100 million from? 50 million from bank loan, 25 from common equity, 25 from preferred equity. And now you want to do another project. You have another investment lined up, another capital investment lined up, and you need to get more capital. So where are you going to get it from? Are you going to get another bank loan? Are you going to issue some more preferred stock or some more common stock? And whatever you will do, wherever you will get more capital from, it's going to impact the weights, right? It's going to impact the weights, and it's going to impact the cost depending on what is the rate they are willing to give you more capital for. And that's why the cost changes for each additional unit of capital that you want. Hence, we're using the word marginal. That what happens is that as you increase the capital that you want, it's highly likely that the providers of capital might start asking you for higher return, because, well, they will have to take on more risk with you. So let's say if I have a diversified portfolio of Apple, Google, Microsoft, Amazon shares, and if Apple says, hey, give more money to me because I want to expand, then I will have to take a higher risk by selling my other shares and taking a more concentrated position in Apple. So if my risk is going up, I want a higher return, right? The same goes for bank. If a bank is giving loans to 100 different companies, but one company wants more, so then the bank might ask them for a higher return or a higher interest rate. And that's why as the business grows, it's likely that the weighted average cost of capital also goes up. And that is what we call the marginal cost of capital. That is why we also call the weighted average cost of capital the marginal cost of capital, because as the business grows, this cost changes. It could sometimes also go down as the company matures, right? So it's not necessarily going to look like this, right? It can also look like this, or it can also just look flat. And we'll talk about that later. But here, all I want you to pick up is the concept that for each additional unit of capital, where you get it from is going to impact the weights, right? And based on that, you will calculate the weighted average cost of capital. And this is why this is also called the marginal cost of capital. Now, as discussed, we have three sources of capital: bank loans or bonds. So you can get bank loans, you can issue bonds, that's all debt, right? That's all debt. Or you can go into the world of equity, right? Which is common shares or preferred shares. And this is the lovely formula for weighted average cost of capital, where you take the weight of debt multiplied by the cost of debt, right? Why I like to write it as KD, but they have written as RD. For preferred stock, I write cost of preferred equity. For common equity, I write cost of common equity, because from the company's perspective, it is a cost. And from the investor's perspective, it is a return. So let's say this investor is earning a return on common equity, but for the company, it is a cost of common equity. So you will see these terms used interchangeably. It's basically the same thing. It's just a matter of perspective. For the company, it's a cost. For the investor, it's a return. So weight of debt into cost of debt into 1 minus the tax rate, because interest is a tax deductible expense like we discussed. Then weight of preferred equity into cost of preferred equity, weight of equity, common equity into cost of common equity. And that is how you calculate your weighted average cost of capital. Right. The weights are proportions of the various sources. So like in the example we took, the 100 million was being financed by 50, 25 and 25. So we took 50%, 25% and 25%, right? A company might have 33, 33 and 33. So that would be its weight. Now, sometimes what happens is the current weightage or the current capital structure is different than what they are planning to have in future, right? The target weights or the new weights, we always have to take the target or the new weights. Why? Because as an analyst, what are you doing? You have your capital investments on one side that the company is planning on making, and you are trying to calculate the NPV for these, right? And to be able to calculate the NPV for this, you are basically going to be using a discount rate, right? And that discount rate, which you will use to calculate this NPV, has to be calculated based on the new targets or the new weights, because this capital investment will be funded. To fund the new project, they will issue either more debt or more equity. So we have to use the newer ones for calculating this NPV, because that is what it's going to look like when the new project is there, right? So we cannot use the existing capital structure or the current capital structure to calculate the NPV of the new project, because if the new project is going to be there, it's going to be funded with either more debt or more equity, which will change the weights of the capital structure. Therefore, we have to take the new weights. Now, how do you find out the new weights? What are the methods of doing that? That is something we will discuss at the end of this learning module. But what you should pick up right now is that always you have to take the target weights, not the current weights, right? So here is an example. These are the current weights. These are the target weights, right? No, sorry. No, they are maintaining these weights. So hence the current is equal to the target, right? So no confusion over here for that, since they are maintaining these rates. The confusion over here is just, it's not a confusion, it's just something that you need to be careful of, is that the cost of debt is given to you before tax. So you need to multiply it with 1 minus the tax rate before calculating your weighted average cost of capital. You have your cost of preferred equity, you have your cost of common equity, and you have your weight of debt, you have your weight of preferred stock, and you have your weight of common equity. So pause the video, please. Try to calculate the WACC, and then I will show you the answer. Right, so hopefully you remember to multiply the cost of debt with 1 minus the tax rate, which is given over here. And of course, the remaining part is easy, and you should have been able to get 11.44. Another question for you, and this question, by the way, is not requiring any calculation. It's a very straightforward question just to check your concept. So pause the video and try to come up with an answer, and then I will show you the answer. Right, so since they are maintaining its capital structure, therefore the current weighted average cost of capital will remain the relevant cost of capital, because the weights are not changing. So that is it for this first video on cost of capital. In the next one, we're going to talk about the factors that affect the capital structure, that should we take on more debt or should we issue more equity, right? What should be the mix? What should be the specific mix of debt and equity? What are the factors? And then we will later on move on to the different theories by Modigliani and Miller, their first theory, their second theory. Then we will talk about the static trade-off theory. And then finally, we will talk about how to get to that optimal capital structure. So that is it for this one, guys. Take a break and I will see you in the next one.